When we talk about credit perspective, there are two major classifications that distinguish bonds from each other. These are whether they are investment grade or speculative grade. Speculative grade bonds come from the companies that get a lower level of credit quality. Investment grade bonds originate from companies that are highly rated credit-wise. There are 4 rating grades for investment grade categories and 6 rating grades for the speculative grade bonds. Originally, there were 3 types of companies whose bonds fell under the description of speculative grade. These were new companies or those in a highly competitive or volatile industry or had unstable fundamentals. But today, many businesses choose to operate with a degree of leverage that somehow defines them in the same league as speculative grade companies. Here's the deal. Speculative grade credit rating normally accompanies corporations with a higher default tendency. Normally, these higher risk companies offer higher interest rates or yields. The good thing is credit ratings are not set in stone. A company's credit rating can go up if their fundamentals improve. On the other hand, they can also downgrade the ratings if the credit quality of the issuer deteriorates. Valuing corporate bonds is a critical step before investment. However, it's not an easy task. Is there a magic formula that investors use to evaluate corporate bonds? Basically, they just look at their yield advantage, otherwise known as yield spread, when placed side by side with U.S. Treasuries. They use Treasuries as a benchmark because investors consider them as completely free of default risk among all the other instruments in the market. That's why when you find highly rated companies such as Microsoft, Exxon, Apple, etc., who have enormous cash balances on their financial statements, they would often offer lower interest. However, investors confidently buy them because they know that these companies will not likely default on their obligations and will pay interest and principal on time. On the other side, companies with higher debt, low liquidity, or unreliable income streams usually get a lower rating. These companies often need to jack up their interest offers a little bit for their bonds to make them more attractive to investors. You see, if you're an investor, the picture is pretty clear and simple. It's your choice between a bond that has a lower risk but lower yield or one that has a higher risk but higher yield. But here's an interesting fact. From the period 1996 through 2012, investment-grade corporate bonds yielded an average 1.67 percentage points higher than U.S. Treasuries. When it comes to bond maturity, there are more options. In their most simple category, you can have your pick between short-term, intermediate-term, and long-term corporate bonds. Aside from the fact that they mature much earlier, short-term bonds usually have lower yields. This rides on the idea that the risk is lower than the issuer would fold up or default in a 3-year period. Obviously, a 30-year bond exposes the investor to a longer period of uncertainty because a lot more things could happen to the issuer within that time frame. Naturally, long-term bonds offer higher yields, but one should not overlook the reality that they tend to be more volatile. If you're getting the services of an investment manager, make sure that he or she is familiar with this aspect of investing. A good one will add value to your portfolio by combining bonds of varying maturities, yields, and credit ratings, so that your investment can achieve the best mix of risk and, of course, return. That's it for now. On our website, you can find more posts as well as calculators and other financial tools. Considering investment in corporate bonds. We would love to know your thoughts, so feel free to share them in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel on YouTube to get the best free financial education videos.